Welcome to Wealth Lab. Today, we're diving straight into a pretty terrifying reality. Most of us just deposit our paychecks, build up our life savings, and put our total trust into the banking system without even batting an eye. But what happens when that trust is broken? Like, what actually happens to your hard-earned cash when a modern bank simply fails? It's definitely a scenario we all hope to avoid. But honestly, understanding the hidden mechanics behind a collapse is literally the only way to truly protect yourself. To wrap our heads around the massive scale of this, let's just look back at 2023. The whole world watched in absolute shock as Silicon Valley Bank collapsed. And guys, they were holding assets worth a staggering $209 billion. That's a B, billion. This wasn't some tiny mom-and-pop regional branch. This was a massive, highly trusted institution. Basically, they got caught holding long-term fixed-rate assets right when their customers suddenly panicked and demanded their short-term deposits back. The whole thing crashed like a house of cards, proving that no matter how big or sophisticated a bank might seem, failure is always a very real possibility. So let's jump into Section 1. It happens more than you think. It's super easy to assume that bank runs are just a thing of the distant past, like black and white movie stuff, right? But bank failures are actually a recurring feature of our financial system. Back in the 1980s, we had the massive savings and loan crisis. Then I'm sure we all remember the global shockwaves of 2008 with the fall of Lehman Brothers and Washington Mutual. Fast forward to 2023, and boom, we see the rapid collapses of Silicon Valley Bank, Signature Bank, and First Republic. The reality is, major financial institutions go bankrupt way more often than we realize. This usually hits when they take on excessive risk or when sudden economic downturns completely wipe out their capital. All right, moving on to Section 2. What actually happens? So when a bank officially crosses the line into insolvency, this very specific, kind of hidden mechanical process kicks in. In the industry, this is known as the classic weekend takeover. Here's how it plays out. Step 1 usually goes down on a Friday evening. Regulators literally wait until the very end of the business week to abruptly close the bank's doors. Then, Step 2, government regulators immediately swoop in and take total control of the whole institution. Finally, Step 3, they spend the entire weekend desperately trying to sell the failed bank's assets to a healthy competitor. If everything goes smoothly, a new bank takes over, and by Monday morning, you might just open your phone and see a brand new logo on your banking app. But if they can't find a buyer and have to liquidate, well, things get incredibly complicated. And this brings us to a huge shift in how these crises are handled today. You've probably heard the term bailout. That's when the government uses taxpayer money to save a failing bank. But after 2008, the laws actually changed, and they introduced something called a bail-in. In a bail-in, the bank is rescued from the inside out. And here is the truly scary part for us. As a depositor, you are technically considered an unsecured creditor to the bank. That means under a bail-in, your unprotected savings could legally be seized and converted into bank shares just to absorb the institution's massive losses. Crazy, right? Now, what's really interesting, and honestly pretty frightening, is this thing called the offset loophole. Picture this. Let's say you have a mortgage of $200,000, but you also have savings of $150,000 sitting with that exact same bank. If that bank goes under, the insolvency practitioner can just look at your net balance, they can legally seize your life savings and apply it directly to your mortgage debt. Just like that, you could lose access to your everyday cash instantly with absolutely zero warning. Which naturally leads us to Section 3, are you protected? Okay, let's take a collective deep breath here. While the mechanics sound terrifying, there are strict government systems designed to shield everyday people like us. If you bank in the United States, your magic number is $250,000. That is the exact limit insured by the FDIC per depositor per insured bank. So if your bank fails, the FDIC's absolute primary goal is to return these insured funds to you incredibly fast. We're talking typically within just 2 business days. It's a remarkably effective safety net for your everyday, day-to-day balances. But what if you're watching from outside the US? Well, don't worry, global protections do exist. In the UK, the Financial Services Compensation Scheme protects up to £85,000. Down in Australia and New Zealand, there are strong government guarantees in place too. However, there is a catch when it comes to your debts. If your lender goes bankrupt and your mortgage is sold off to a new financial institution, they might not honor any leniency you previously had. If you happen to be a high-risk borrower or you're a bit behind on payments, you could literally be forced into a super difficult refinancing situation with much less favorable terms. And this brings up a super common question we get. Are safety deposit boxes actually safe? I mean, you'd probably assume that physical items sitting inside a metal box inside a bank vault are completely immune to the bank's financial health. But unfortunately, they really aren't. During a severe bank liquidation, those boxes can be temporarily locked right down. In the worst case scenarios, access is entirely frozen by government authorities while they audit the bank's assets. You could literally be separated from your most valuable physical items for weeks on end. If you're finding this valuable, please subscribe to Wealth Lab and share this video with your friends and family. It really helps us grow. All right, let's move into section 4, protect yourself. Now that we've covered the history, the hidden mechanics, and the laws, here are 3 highly practical steps you can implement to safeguard your money right now. Number 1, spread your funds out across multiple banks. Just never, ever keep more than your local insured limit in a single institution. Number 2, if you're lucky enough to have a lot of cash on hand, use services like CDARS or ICS. These networks actually automatically divide your excess cash across multiple insured banks for you, keeping every single penny protected. And number 3, consider private vault facilities or high-quality home safes for your physical valuables. This entirely removes your family heirlooms and crucial documents from the banking system's risk pool. So I want to leave you with this final provocative thought to chew on. Is your money truly safe today? It's a critical question we all need to answer by taking proactive steps long before a crisis actually hits. Thank you for joining us today. If you haven't already, don't forget to subscribe to Wealth Lab. We'll see you in the next one.